This is Eric Mwatha with Mwatha.com. Let's continue here with our lesson on the RSI wedge breakout. We're going to be taking a look at Sohu when it was trading in the early 2000s. And you see initially the stock had IPO during the tech bubble bust of 2000. At some point before 2003, you see the stock took off, jumping from about under $2 all the way to $42 in less than a year. Huge move, absolutely massive move. So the stock went into a multi-year consolidation period, and we formed this massive wedge, and the RSI on the monthly chart also forms a massive wedge, and the stock was a buy, absolutely a buy, once it moved out of that wedge right there, which was sometime in June 2007. And again, you see the RSI breaking out there. That was an absolute breakout of that wedge formation. So now we fast forward and we see what happened after that wedge breakout. Remember, the breakout from the prior chart was in 2007 here in June. Also breakout out of that triangle there, and you see that we moved swiftly from about 26 all the way to about 90 in a short order, in less than a year. Huge move. So that's the lesson there, that you can use the RSI wedge breakouts also on monthly charts. Now, it really would make a lot of sense if we explained what happened in 2008. Notice the stock eventually would pull back from 90 all the way to about 35. And what I wanted to point out here as an additional lesson here is, notice that the price was forming new multi-month highs, all-time highs here. But take a look at what the RSI was doing. The RSI, if you connect this high and these two highs here, you had a double top. And once we had that double top on the RSI, on the monthly, that was your cue to sell. So about here in the higher 80s, you would have been out of the stock before it dropped from 90 all the way to 35. Now let's take a look at, again, the same stock. This time we're taking a look at the daily, what the stock did in April 2008 on the daily. Again, you see another formation that the stock had formed a huge price wedge, but what we are looking at here mainly is the RSI wedge. And once we broke out of that wedge, which is right there, which coincides with a price jump, we moved from about the 47 area all the way to 90. So again, the RSI wedge breakout here could have told you that this was a good entry point in the stock, having broken out in that area. As an additional lesson, let's take a look at what happened, because again, the stock did eventually give back the gains, moving from $90 all the way to about 35. What is important here from a technical lesson standpoint is that we see that the price on the daily chart was making new highs, and yet the technicals were making lower lows. So that was negative divergence, and that was when you should have realized that area there was a sell. Okay. Also, interestingly enough, if you take the lows, this low on the RSI and this low on the RSI, draw a straight line, you'll notice that this back testing of this line here and again here, these two areas here, corresponds to this high here and that high there. So again, you had another reason to get out of the stock, because quite frankly, the back test here had failed for a second time right there. So that was your cue that that was another high in the stock. It was time to get out. Because this chart provides us with so many learning opportunities, let's take a look at what happened between September and November 2008, you see that the price now was making new daily 52-week lows here. It was going lower over a period of months and weeks, but the technical picture kept improving, as you can see. So you had positive divergence, and this is November of 2008. The stock hit about 35. So this was a buy signal, given the fact that prices were making short-term lows and the technicals were improving. Now, if we go on and take a look at what happened, this is 2008. So that there was the low on the stock, given that negative divergence. And you see the stock went on trading from about 35 all the way to 70. So if you use that negative divergence on the daily, you would have had an opportunity to own the stock around there. Again, while we are continuing with our lesson here, I just wanted to sidetrack a little bit and use this chart because it has a lot of things for us to study. Number one, remember, again, between 2007 and 2010, we had this RSI top lines formation here. The reason why this was a primary line on the RSI, this line here, is because it connected to an all-time high at the time. So once this line was breached to the upside right there, sometime in the middle of 2010, the stock became a buy right there at about the higher 40s, and we saw the stock move blasting out of that primary line breakout formation on the RSI right there, pushing the price from about higher 40s all the way to about 110. So you doubled your money in less than 1 year, or about 1 year's time. That was a massive move. Again, on this chart, we see another sell signal before the stock fell from 110 all the way to 35 again. We see that weekly chart was making new weekly all-time highs here, but the technicals were deteriorating here. That was negative divergence, and that was your cue to get out. Sohu early on in 2002. What I want to ask you is that in 2002, would you have bought this stock when it broke out above $2.40? Notice that, as a hint, the RSI was making an all-time high. So if you take this weekly chart in late 2002, that there, was that something that you would have taken an action and bought the stock? Because this is what happened down the road. From breaking out above 240, the stock moved from there to 42 by June, July of 2003. That was a massive move because the stock right there was trading at that particular point, making an all-time weekly RSI high. Stay with me on these lessons on how to trade the market situations where we can take advantage of the technical picture, technical chart setups. Again, breakouts are powerful tools. And so let's continue on with this lesson. This is Eric Mwatha with Mwatha.com. Peace and blessings.